Here is section 1. The money in your wallet right now, that bill, that coin, that number glowing on your phone screen, do you ever stop to wonder where it actually came from? Not the store where you earned it, not the bank where you deposited it, but the very first moment it was born into existence. Because here is the thing that most people never ask, and fewer still ever discover, that money, in the modern world, does not begin with work. It does not begin with gold pulled from the earth or silver melted into coins. It begins with a promise. A debt. A signature on a piece of paper that says I owe you. And somewhere, woven into that quiet transaction, is a system so vast, so carefully constructed over centuries, that it shapes the lives of nearly every human being alive today, most of whom have no idea it exists in the form it does. This is the story of how central banks were built, how debt became the engine of modern money, and how a system designed in the corridors of power centuries ago still reaches into your pocket, your mortgage, your future, right now. If that sounds dramatic, stay with me. Because the history here is far more dramatic than anything I could invent. To understand how we arrived at this moment, we have to go back. Far back. Back to a world where money meant something you could hold in your hand and feel the weight of. A world of gold and silver, of kingdoms that rose and fell on the contents of their treasuries. For most of recorded human history, the concept of money was simple in principle, if not always in practice. You had something of value, metal, grain, livestock, and you exchanged it for something else of value. The coin in your hand represented real material, mined from the earth, shaped by human labor. There was a ceiling to how much money could exist because there was a ceiling to how much precious metal could be extracted and minted. But even in the ancient world, people began to notice something interesting. Carrying gold everywhere was inconvenient. It was heavy, it could be stolen, and it was difficult to move in large quantities across long distances. And so, naturally, a solution emerged. Merchants and wealthy individuals began depositing their gold with trusted figures, goldsmiths, early bankers, temples and some societies, who would hold the metal in safekeeping and issue a receipt. A piece of paper that said, in effect, the bearer of this document is entitled to this amount of gold held in our vault. And here, quietly, almost without anyone noticing, the first seed of something enormous was planted. Because people soon discovered that it was easier to trade the receipt than the gold itself. Why carry heavy coins when you could pass along a piece of paper that represented those coins? The receipts began to circulate as a kind of currency, and the goldsmiths, clever, observant people, began to notice something remarkable. Depositors almost never came to collect all of their gold at the same time. There was always gold sitting in the vault, idle, uncollected. And if that gold was just sitting there, what if they issued a few extra receipts? Receipts not tied to any specific deposit, but to gold that was simply there, available? They could lend those extra receipts out, charge interest, and so long as depositors did not all come rushing for their gold at once, no one would ever know. The vault held, say, 100 coins. But now there were 150 receipts in circulation. Money, in a sense, had been created from thin air, or more precisely, from the confidence that the system would hold. This was fractional reserve banking in its infancy. And it changed everything. If you're finding this story fascinating, and I think you will, I'd love it if you hit that like button. It helps more people discover this history, and trust me, the further we go, the more astonishing this gets. Here is section 2. Now, this quiet transformation in the vaults of medieval goldsmiths might seem like a minor technical detail. But what it set in motion was nothing less than the eventual redesign of how entire civilizations would function. Because once you accept that money can be created through credit, through lending, then the question is no longer how much gold do we have. The question becomes how much can we lend? And that question, it turns out, has a very different kind of answer. The 17th century in Europe was a period of almost constant warfare, political upheaval, and staggering expense. Kingdoms needed money, enormous sums of it, to fund armies, build navies, and maintain the machinery of power. And the problem that every monarch kept running into was the same: there was never enough gold in the treasury. Wars did not wait for convenient tax collection schedules. Enemies did not pause while kings scraped together funds. And so rulers borrowed. They borrowed from merchants, from wealthy families, from anyone who had gold to spare and was willing to charge interest for it. But borrowing from private individuals was unreliable. Relationships soured. Lenders died. Terms were disputed. What European governments desperately needed was a more permanent, more systematic source of credit. And in 1694, in England, they found it. The Bank of England was born not from some grand philosophical vision of how money should work, but from a very specific, very urgent problem. England was at war with France. King William III needed money. A Scottish merchant named William Paterson proposed a solution. A group of private investors would lend the English crown £1.2 million at 8% interest per year. In exchange, these investors would be incorporated as the governor and company of the Bank of England, given the right to issue banknotes, and enjoy the backing and prestige of a royal charter. It was, at its core, a deal. The government got the cash it needed. The investors got a guaranteed return, underwritten by the full authority of the state. And the Bank of England, the world's first true central bank, was born. What is remarkable about this moment is how openly transactional it was. There was no pretense that this was purely about public good. It was a partnership between government power and private capital, and both sides understood exactly what they were getting. But the consequences of this arrangement would echo across centuries in ways that neither William III nor William Paterson could have imagined. Here is where the story begins to deepen into something that feels almost architectural, the construction of a system with its own internal logic, its own momentum. Because once the Bank of England was established, something fascinating began to happen. The bank issued notes, paper receipts, essentially, in excess of the gold it actually held. It could do this because it had the confidence of the government behind it. People trusted the notes because they trusted the institution, and they trusted the institution because the state had given it legitimacy. And with that trust, the bank could lend. Enormously. Creatively. In ways that created money where none had existed before. Think about what this means for a moment. A merchant in London comes to the Bank of England seeking a loan. The bank does not go to its vault, pull out gold coins, and hand them over. It writes the merchant a note, a promise, that says this person has credit from the Bank of England. That note circulates in the economy as money. People accept it in transactions. It pays wages, buys goods, funds enterprises. All of this economic activity is powered by a note that was created, essentially, by an act of writing. The merchant owes the bank money, with interest. But the money they owe never fully existed before the loan was made. The debt came first. The money followed. This is not a conspiracy. This is not a secret hidden from the public. It is, in fact, how economists today describe money creation in a fractional reserve banking system. When a bank makes a loan, it credits the borrower's account. That credit is new money. It did not exist before the loan. And it is tied, from the moment of its birth, to a debt that must be repaid, with interest. Which raises a question that I want you to sit with for just a moment, because it is genuinely profound. If money is created when debt is created, and if that debt carries interest, then the total amount owed always exceeds the total amount of money in existence. There is always more debt than money. The system, by its very design, requires constant expansion, constant new lending, constant new debt, just to keep functioning. Does that sound like a stable foundation? Or does it sound like something that needs to keep running just to stay in place? Hold that thought. Because it matters. The model pioneered in England did not stay in England for long. Over the 18th and 19th centuries, central banks began to appear across Europe and eventually beyond. France, after the chaos of its revolution and the financial experimentation of that era, eventually established its own Banque de France in 1800, under Napoleon, who understood that modern warfare required modern finance. Other European powers followed. Each country developed its own variation on the model, but the core structure remained remarkably consistent: a central institution, often with private shareholders or at least private roots, given a special relationship with the government, granted the authority to issue currency, and tasked with managing the nation's credit. And governments, freed from the hard constraint of how much gold was in their treasuries, began to borrow in ways and at scales that would have been literally impossible before. Wars were funded not by taxation alone, but by bond issuance. The government would issue promises to repay, the central bank would help manage and sometimes purchase those bonds, and money would flow into the war effort. The Industrial Revolution was financed, in significant part, by credit created through this expanding banking system. Railways, factories, canals, the infrastructure of the modern world was built on borrowed money. This was not inherently sinister. Credit, used well, allows societies to build things faster than they otherwise could. A farmer who can borrow to buy equipment today and repay from next year's harvest is genuinely better off than one who has to save for a decade. The same logic applies to nations. But the expansion of credit-based money also concentrated an enormous amount of structural power in the hands of those who controlled the credit. The central banks, and the private banking systems that operated within the frameworks they established, became indispensable to the functioning of modern economies. To cut off the credit was to stop the economy. And that meant that governments, businesses, and ordinary people were all, in different ways, dependent on the continued goodwill of the banking system. If you're watching this and thinking about sharing it with someone who has ever wondered how the financial system really works, now would be a great time to do that. These are the kinds of conversations that deserve to happen at dinner tables and in classrooms, not just in economics lectures. Now, let us cross the Atlantic. Because the American chapter of this story is in many ways the most dramatic, and it is essential to understanding how the modern global system was eventually assembled. The United States had a complicated, even turbulent relationship with central banking from its very founding. The debates between Alexander Hamilton, who wanted a powerful central bank modeled on the Bank of England, and those who feared that such an institution would concentrate too much power in too few hands, were among the most consequential arguments in early American political history. Hamilton won the first round. The first Bank of the United States was chartered in 1791. But the forces opposed to it, agrarian interests, states' rights advocates, and those who genuinely feared that a central bank would serve wealthy elites rather than ordinary citizens, were powerful. The bank's charter was not renewed in 1811. A second attempt followed. The Second Bank of the United States was chartered in 1816, and it too quickly became a political battleground. President Andrew Jackson viewed the bank as an instrument of elite financial interests. He made destroying it a personal crusade, and he succeeded. When the bank's charter expired in 1836, the United States entered a long era without a central bank. What followed was a fragmented financial system, hundreds of state-chartered banks, each issuing their own currencies and operating under their own rules. The results were, to put it gently, chaotic. Financial panics erupted again and again: the Panic of 1857, the Panic of 1873, the Panic of 1893, and eventually the Panic of 1907. Each crisis followed a similar pattern. Depositors rushed to withdraw their money. Banks collapsed. Credit froze. Businesses failed. Workers lost their jobs. Savings vanished almost overnight. After each panic, the same argument returned. America, many believed, needed a lender of last resort, a central institution capable of providing emergency liquidity to banks during crises, preventing a financial scare from cascading into a full economic catastrophe. The Panic of 1907 became the decisive moment. The crisis was severe enough that one man, the powerful banker J.P. Morgan, effectively stepped in to stabilize the system using his own influence and resources. Morgan gathered bankers in his library and forced them to coordinate rescue loans to failing institutions. The intervention worked, but it exposed a frightening reality. The stability of the entire American financial system had depended on the judgment and goodwill of one private individual. That was not a sustainable solution. Reform was inevitable. And yet, the reform that followed would emerge in a way that remains one of the most fascinating and controversial episodes in American financial history. In the autumn of 1910, a small group of the most powerful figures in American banking and finance quietly traveled to a private island off the coast of Georgia, Jekyll Island. The trip was shrouded in secrecy. Participants used only first names. They avoided public attention and traveled separately so reporters would not suspect anything unusual. For 9 days, these men worked behind closed doors on a proposal that would reshape the American financial system. Among them was Senator Nelson W. Aldrich, chairman of the National Monetary Commission. Alongside him were some of the most powerful bankers in the country, representing institutions that controlled a massive share of American finance. Also present was a representative from the U.S. Treasury. Their goal was ambitious: design a central banking structure for the United States. The secrecy was deliberate. Those involved understood that if the public, or even most members of Congress, discovered that a plan to reorganize the entire financial system was being drafted primarily by elite bankers, the political backlash could be explosive. So the proposal was crafted carefully. It would appear to be a government institution. But it would incorporate many of the structural ideas that private banking interests had advocated for decades. 3 years later, in December 1913, the plan became law. The Federal Reserve System was born. The Federal Reserve Act established a unique structure, neither fully public nor fully private. The new system consisted of 12 regional Federal Reserve banks spread across the country, each technically owned by member commercial banks, while oversight would come from a central board of governors appointed by the president. This institution now possessed powers no American financial authority had ever held before. It could issue national currency. It could set the interest rates at which banks borrowed emergency funds. And most importantly, it could act as the lender of last resort, stepping in during financial crises to stabilize the banking system. From the very beginning, debate surrounded the Federal Reserve. Some historians and economists argue that it was designed primarily to protect financial stability and prevent the devastating bank runs that had plagued the country for decades. Others argue that it largely served the interests of the banking industry itself. That debate continues more than a century later. What is beyond dispute is that the system created in 1913 still governs the financial structure of the world's largest economy today. But the 20th century would quickly test this new system in ways its designers could hardly have imagined. The first great shock arrived with the outbreak of World War I. Governments suddenly faced wartime expenses on a scale never before seen. Nations borrowed vast sums, issued enormous amounts of debt, and increasingly relied on central banks to help finance the war effort. To keep the system functioning, many countries abandoned the gold standard, the centuries-old rule that tied currencies to a fixed quantity of precious metal. Without that constraint, governments could print money more freely. But the consequences were severe. Inflation surged across Europe and beyond. When the war ended, policymakers attempted to return to the gold standard, hoping to restore financial stability. Instead, the transition created enormous economic tensions that contributed to the greatest economic collapse of the modern era, the Great Depression of the 1930s. Banks failed across the United States and Europe. Credit disappeared. Unemployment soared to unimaginable levels. Factories shut down, trade collapsed, and millions of families faced poverty. This crisis fundamentally changed how economists and policymakers thought about money and economic management. One of the most influential voices during this period was the British economist John Maynard Keynes. Keynes argued that governments should not simply wait for markets to correct themselves during economic downturns. Instead, governments should actively intervene, increasing spending during recessions to stimulate demand and keep the economy moving. Central banks, in this new framework, became powerful tools of economic policy. In 1933, U.S. President Franklin D. Roosevelt took a dramatic step. He removed the United States from the domestic gold standard. American citizens were required to turn in their gold coins and certificates in exchange for paper dollars. The link between the dollar and physical gold became increasingly managed by government policy rather than fixed by nature. Then came an even larger shock: World War II. Once again, governments borrowed enormous sums to finance the war. Once again, central banks played a crucial role in sustaining the financial system during unprecedented spending. When the war finally ended, world leaders faced a monumental challenge. They needed to design an entirely new global monetary system. In July 1944, representatives from 44 nations gathered in the quiet resort town of Bretton Woods. The conference that took place there, known as the Bretton Woods Conference, would reshape the global financial order. Two new international institutions were created, the International Monetary Fund and the World Bank. But the most important decision involved the role of the US dollar. Under the new system, global currencies would be pegged to the US dollar, and the dollar alone would remain convertible to gold at a fixed rate of $35 per ounce. This arrangement effectively made the dollar the world's reserve currency. And that gave the United States an extraordinary financial privilege. Because countries needed dollars for international trade and reserves, the United States could run deficits, sending dollars into the global economy while receiving real goods and services in return. But this system contained a hidden tension. The more dollars the United States issued to supply the world, the more its gold reserves were stretched. If too many countries demanded gold in exchange for their dollars, the United States would not have enough gold to fulfill those promises. By the late 1960s, that pressure had reached a breaking point. The costs of the Vietnam War and massive domestic spending programs dramatically increased the supply of dollars circulating worldwide. Some countries, most notably France, began demanding gold for their dollar reserves. The system was cracking. Then, in August 1971, U.S. President Richard Nixon made a historic decision. He closed what was known as the gold window. The United States would no longer exchange dollars for gold. With that single announcement, the final link between money and a physical commodity was severed. The dollar, and eventually nearly all major global currencies, became what economists call fiat money. Money backed not by gold or silver, but by trust, by belief, by the full faith and credit of governments. Since 1971, the money people earn, save, and spend has been supported not by metal stored in vaults, but by collective confidence in the system itself. And that change opened the door to something entirely new. Central banks could now expand the money supply with unprecedented flexibility. Governments could borrow on scales that the old gold standard world would never have allowed. The modern global financial system had fully arrived. The decades that followed saw an extraordinary expansion of global debt. Governments, corporations, and individuals all borrowed more. The financial sector grew in size and complexity. New instruments were created, bonds, derivatives, collateralized debt obligations, that extended credit in ever more sophisticated ways. Central banks, managing this system, became some of the most powerful institutions on earth. Their decisions about interest rates rippled through mortgage markets, equity markets, employment, and wages across the entire global economy. And here is where the fundamental dynamic we identified earlier, the one about debt always exceeding money, becomes most visible. In a world where money is created through lending, where the supply of money can be expanded almost without limit, where governments finance themselves through bonds that central banks can effectively purchase by creating new money, the total stock of debt in the world grows. It grows not because of any conspiracy, but because that is what the system is designed to do. Debt is the mechanism of money creation. More money requires more debt. By the early 21st century, global debt, the combined debts of governments, corporations, and households, had reached levels that dwarfed anything in previous history. After the financial crisis of 2008, when private credit markets seized up and threatened to take the entire global financial system down, central banks responded with tools that would have seemed extraordinary just decades before. Interest rates were cut to near zero. Trillions of dollars, euros, yen, and pounds were created and used to purchase government bonds and other assets, in programs called quantitative easing. The balance sheets of central banks expanded to sizes that were genuinely staggering. The stated goal was stability, to prevent the kind of cascading collapse that had turned the credit crunch of the 1930s into the Great Depression. And to a significant degree, it worked. The immediate crisis was contained. But the long-term consequences, the persistent low interest rates, the asset price inflation, the ballooning national debts, are still being debated, and in some cases still being felt. So here we are. Centuries after those first goldsmiths noticed that their depositors never came for all their gold at once. Decades after the gold window closed and money became entirely a matter of confidence and credit. We live inside a financial system where the money in your bank account was almost certainly created by a loan somewhere, your mortgage, a corporate bond, government borrowing, and where the total debt in the system always, structurally, exceeds the total money available to repay it. This is not a horror story. It is a story about how human institutions evolve, how they solve real problems and create new ones, how the structures built by practical people responding to practical pressures in one era become the inherited architecture of the next. Central banks were created because financial panics were devastating. Fiat money replaced the gold standard because the gold standard could not sustain the demands of modern economies. Fractional reserve banking expanded because credit genuinely enables growth and investment that benefit real people. But understanding this history, really understanding it, also means grasping the degree to which the financial system is a human construction. It was designed by people, for purposes that those people understood and intended, and it has evolved through decisions made at specific moments for specific reasons. It is not natural law. It is not inevitable. It is, at its core, a set of agreements about what money is, about who can create it, about how debts will be honored and by whom. And agreements, as history has repeatedly shown, can be renegotiated. They can be reformed. They can be built differently. The system we have today was not the only possible outcome of the choices made at Jekyll Island, or at Bretton Woods, or in the treasury of William III England. Different choices were available. Different choices produced different systems in different places and different times. Which means that the most important question this history leaves us with is not how did we get here? The most important question is, now that you know how it was built, what do you think should be done with it? That question has no easy answer. Economists disagree. Policymakers disagree. Ordinary people, when they understand the system well enough to have a view, disagree. But the disagreement can only be productive if it is informed, if people understand what they are actually arguing about. And that is why this history matters. Not because it proves any particular ideology right or wrong, but because you cannot meaningfully participate in conversations about monetary policy, about national debt, about interest rates and inflation and the future of the financial system, without understanding how that system came to be. You have been living inside this structure your entire life. Every mortgage payment, every credit card swipe, every government budget that is funded partly by borrowing, all of it is part of a system with this history behind it. The debt that feels personal, that keeps you up at night, exists within a context in which debt itself is the mechanism of money creation. The taxes that fund governments include interest payments on bonds that trace their lineage back to deals made centuries ago. The value of the currency in your wallet is maintained by institutions whose origins lie in private arrangements between governments desperate for cash and investors hungry for guaranteed returns. This is your financial world. You deserve to understand it. If this documentary changed how you think about money, even slightly, I want to hear about it in the comments below. What surprised you most? What questions does this raise for you? Because the conversation that starts in those comments is, in its own small way, part of how a more financially literate world gets built, one curious person at a time. And if you want to keep pulling on these threads, if you want to understand more about how the systems that shape your life were constructed and how they actually function, subscribe to this channel. There is so much more history to uncover. So many more systems to understand. So many more moments where the decisions of a few people in a room quietly changed the world for everyone else. The money in your wallet began as a debt. The system that created it has been centuries in the making. And the future of that system, what it becomes, who it serves, how it evolves, is, at least in part, a story that has not yet been written. Maybe you will be part of writing it.